Hello everyone, this is Kevin Zhao. In this chapter, we will go through the mechanism of security trading, including types of brokerage firms, types of brokerage accounts, types of orders, margin trade, and short sales. We will also discuss the role of security market regulation. Investors do not need to travel to New York City or Chicago to trade securities on the exchanges. Security brokers can help investors to execute financial transactions with much lower costs and greater convenience. Brokerage firms are financial institutions that offer securities trading services to investors. There are two types of brokerage firms, the full-service brokers and the discount brokers. Full-service brokers offer not only security trading services but also investment advising services. Therefore, they charge higher fees to investors. Discount brokers offer trading services through their online platform with very limited access to their investment advising services. They charge a much lower fee for investors, typically $7 to $10 commission fee per trade, regardless of the size of the transaction. Normally, institutional investors choose full-service brokers, and individual investors choose discount brokers. Three types of accounts can be established with a broker: the cash account, the margin account, and the wrap account. In a cash account, investors do not have access to additional funds that can be lent to them by brokers. In a margin account, investors can borrow funds from brokers to amplify their security positions. In a wrap account, brokers match investors with outside money managers and all costs wrapped into one fee. In some rare scenarios, investors do not need to set up a brokerage account for security trading. For example, investors can reinvest dividend received from a company into stocks through the dividend reinvestment plans, or DRIPs, offered by the company. Investors can also set up a Treasury Director Program, DSP, with the Treasury Department to purchase certain types of Treasury securities. Security trading orders are handled differently on NASDAQ and the New York Stock Exchange. New York Stock Exchange is an auction market, while NASDAQ is a dealer's market. On New York Stock Exchange, buyers and sellers can match their orders directly through brokers on the centralized trading floor. On NASDAQ, all orders have to go through market maker's hands through its electronic system. Algorithm trading is an automated trading program based on computer algorithms. It's often used by hedge funds or other large financial institutions. High-frequency traders often trade multiple times each day on the same securities based on sophisticated trading programs. Investors have three choices on security trading orders: the market order, the limit order, and the stop order. The market order accepts best available price on the market. It assures the immediate execution of transactions, but allows the control on the price. The limit order, on the other hand, gains control on stock prices by specifying a particular price at which stock can be bought or sold. However, the downside of limit order is that there is no guarantee that orders can be executed promptly. Investors have to wait until the specified price is satisfied. The stop order is something in between. It specifies a particular market price at which market order is authorized. In U.S., security transactions are settled in 3 business days. For example, an investor bought 100 shares of IBM on Friday. That 100 shares of stock will arrive officially in investors' account on next Wednesday. In theory, investors cannot sell shares that they bought until it's settled in 3 business days. But in practice, investors can sell shares immediately after the order executed, because although shares they bought are not available for sale due to the settlement rules, but the same shares can be borrowed from the broker for selling. On the financial markets, both securities issuance and security trading are highly regulated by the regulator, the SEC, Security Exchange Commission. The goal of SEC is to protect the minority investors' interest as well as maintain and enforce integrity of the market. Security Act of 1933 was established by the U.S. Congress. The main purpose of this law is to regulate corporations' behavior during the stock issuance process. It requires all corporations to register their proposed public stock offerings with the regulator. Security Exchange Act 1934 established the SEC. It also defines and prohibits both insider trading and security price manipulation. The most valuable assets for financial professionals is not money, but trust. Financial professionals often need to adhere to higher standards of ethical beyond what law requires. Therefore, self-regulation is critical for them to build a solid relation with their clients and ensure long-term career success. FRNRA, Financial Industry Regulatory Authority, is the most important self-regulation organization for financial professionals. Security Investor Protection Corporation, or SIPC, is a governmental organization that offers insurance to brokerage customers against brokerage firms' bankruptcy. The complaints filed by investors against brokerage firms can be resolved through either mediation or arbitration. While mediation decisions are non-binding, arbitration decisions are binding. Investors who hold a margin account may borrow money from the broker to double his or her stock positions. Brokers charge interests for the fund lent to investors. Margin trading used to magnify potential gains, but also magnifies potential losses. The Federal Reserve sets minimal initial margin on securities. It is unchanged since 1974 at 50%. If an investor has $100,000 in his or her account, he or she can borrow up to another $100,000 from the broker for stock trading. In addition, actual margin at any time cannot go below the maintenance margin level. A margin call may be triggered when equity in account is below the maintenance margin requirement. Investors who expect the price of stock they do not own to decline can borrow stocks and sell it short. When stock prices decline to the expected level, investors can repurchase the same stocks at low prices, and the share be returned to the broker to close or cover the short sell position. This graph shows you the entire process of short selling. That's all for this chapter. This is Kevin Zhao. I hope you enjoyed this video, and I'll see you in next class.